Hi everyone and welcome to the Panic Drop channel. Today I wanted to discuss some data. We have banks crashing, so this is an interesting picture about banks. It says whenever the bank index falls over 10% in 2 days, after 12 months the returns are positive. So let's look at the first example. In the year 2000, we had the bank index crashing 24% and the S&P 500 rebounded 4% 12 months after, meaning the market was positive after 1 year. The next example is 2008. The bank index crashed 44% and the S&P 500 closed 6% positive 12 months later. And the last example is more recent in 2020 when the bank index crashed 18% and the S&P 500 closed 46% positive 12 months later. So the average drop in 2 days is 15% with a positive return of 23% after 12 months. The bank index this month is already down 17%, but I'm already sure it's more than 10% in 2 days, which means on average we could expect a 23% gain after 12 months. The next image is something I've discussed before in previous videos. This is a global fund manager survey and they ask the managers how much percent it's more likely to have a recession in the next 12 months. This is the same survey where you can see the probability of recession fears are coming lower. So this could confirm that the top is in for the recession fears, just like in April 20 and March 2009. And these tops are also the bottoms of the stock market back in those days. And November 22 is also in line with the bottom we had in October 22. So this image suggests that the bottom could be in. This image gives data of the S&P performance in the 6 months after a 4% January and negative February month. So every time the year starts with a positive January over 4% and the February is negative, 6 months after we have a positive gain on average, which you can see here. So let's see the first year in 1958. We had a 4% gain in January and a minus 2.06% in February with a 17.38% gain in August. Now, the next year is almost 5% gain and a minus 3% in February, and this gave a 11% gain in August. The next year, we had a whopping 11% gain in January, and then the market dropped 1% in February. And ultimately, the market gained 2.8% in August. Now, it's 2023 and January has closed 6.18% and February has closed minus 2.61%. So we can conclude there is a higher probability the market will be up in August. This chart is showing the S&P 500 and you're seeing red dots everywhere. So what does that mean? It's written here. So every time the S&P 500 traded above the 200 daily moving average for 18 days after a 20% decline, they went and checked the results. So I have the results here, and this was the day of the signal, and 12 months later the S&P 500 ended positive. So that's 100% probability. The same actually for 6 months, we have a 100% probability the market ended positive, and also for 3 months. That's quite interesting because right now the stock market has traded over 18 days above the 200 daily moving average. The problem is the price is now back below the 200 moving average, so it's possible we could get a continuation of the bear market, but this data suggests that the returns after 3, 6, and 12 months should be positive. And then we have one last image concerning earnings, because I hear a lot of people stressed about companies having bad earnings. Well, this is some interesting statistics. Every time the earnings went negative after a bear market, the gains for the S&P 500 were massive. So we had in March 2020 minus 15% in earnings, and the market gained 75% when it bottomed. The same for the earnings dropped 7%, and the S&P 500 gained 69% after the bottom. So on average, when the earnings drop 2.3%, you can have a 45% after the market has bottomed. And right now, we'll have to see if earnings get negative, but it would also mean that there is a higher probability the market will end positive 1 year later. Okay, so these are the charts I wanted to show you. If you liked it, please like and subscribe, and see you next time.